Are you ready, you guys?
Yes.
I call the February 13th meeting of the Legislative Commission on Pensions and Retirement to order. A quorum is present. The first item on the agenda is approval of the meeting minutes from February 6th. Is there a motion? Senator Frantz, have you had a chance to look at the minutes?
So moved, Madam Chair.
Senator Frantz moves approval of the February 6th, 2023 meeting minutes. All those in favor say aye.
Aye.
And those opposed say nay. The motion prevails and the minutes are adopted. We do have a lot on our agenda today, so we're going to try to get through everything to respect everyone's time. So our next agenda item is a presentation from the State Board of Investments, Executive Director Jill Schertz, about the history of rates of return within our public pension funds and also the state's investment portfolio. This was a request from our last meeting from some of our members who wanted to know more about how we invest our funds. And so Director Schertz and her team, if you could come up and then introduce yourself for the record.
Good morning, Madam Chair. My name is Jill Schertz. I'm the Executive Director and Chief Investment Officer of the Minnesota State Board of Investment. I'm joined today by our Deputy Director, Mr. Andy Christensen, and our Director of Legal Affairs, Mr. John Muley. Thank you, as always, for the opportunity to come and testify. It's greatly appreciated. I think if we need to come every week, I think Mr. Christensen would be delighted to present as often as you need him to. Today, if we're successful, we're going to tackle 3 or 4 topics. 1, always grounding ourselves in our mission. 2, an explanation of where we are today and our historic returns. 3, where are we headed and what do our markets look like? How do we think about asset allocation? And if we have time, a very brief discussion of investment return assumption. If I'm successful, we'll do this in a way that limits complexity. Having just spent Friday with my mother trying to get her on Hulu Plus Live from 1,000 miles away, I am confident that this will be less complex. So, with that, I'd head to the first page. Again, always grounding ourselves in our mission. It's simple and clear. Our primary purpose is to maintain the viability of the retirement systems. Within that, we are equally clear that our North Star is to consider all relevant and material risks and opportunities as we think about investments. I won't belabor the next slide. We talked about it when we presented 2 weeks ago, but currently, as of June 30th, we're about $125 billion of assets. We manage those assets on behalf of a number of pools, including the combined funds, which we'll be focused on today. And on the right-hand side, you can see the breakdown of those combined funds, which consist of PARA, MSRS, and TRA. Digging a little deeper, though, as we go and look into the actual portfolio, we think about it on a day-to-day basis really in 2 ways. On the left-hand side, we think about it really in terms of our asset allocations and what are the asset classes that make up those asset allocations. And as you can see in the first ring, simply put, we invest in fixed income, private markets, and public equity. I won't go into detail, but on the outer ring, you can see the sub-asset classes that make up each of those target assets. On the right-hand side reflects another way that we think about the portfolio, and that I think is incredibly important for investors. And we'll talk about this a little bit more when we dive into asset allocation later. But we also think about the role that each of these asset classes play in creating a long-term viable investment program. One of the things we were brought here today to talk about was our historic returns. How we're judged by our board really is simply on a 10-year basis and 20-year basis, have we achieved 2 things. On a 10-year basis, have we matched or exceeded our composite return? And have we presented 3 to 5 percentage points over inflation for our members? These bars are remarkable because they seem so simple and so clear. The purpose of the next few slides is to really show you what happens year to year, what happens underneath these very simple and clear numbers. Because if this is all we saw, you'd walk away thinking 9.4%, 8.2% seems pretty easy. So I want to spend a minute talking about what are the markets that we live in. We live in really, if I break it down into simple terms, We live in two big markets, equity markets and fixed income markets. Now, as we think about that, and you think about the solid blue lines you just saw, how simple and clear those are, this next chart, while it's a little bit of eye candy, what this shows you is over a 43-year period, how those returns have varied in equity markets every single year. But even more interesting, at least to somebody in my seat, as you look at those red dots below, that's what's happened in between the years. So interestingly, in our world, we live in a world where what happens matters really where you snap the chalk line. Yeah. We don't live in this continuous 1,000-year world. Every single year we get judged. So as you look at this, I think some of the interesting points, if you look at the 2020, we ended the year up 16 on a calendar year basis when I say we, the S&P 500. But look what happened in between during the year. At one point, it was down 34%. There were countless investors during that period of time that probably thought the world was coming to an end. Many people did. And if they cashed in at that point, they missed what happened the very next year when it was up 27%. I could go on and list these, but you can see from the chart, tremendous volatility. Why do I show you this? Because it goes to one of our core investment beliefs. We are long-term investors, and if you can withstand short-term volatility, you will succeed. Now, some might say, given how volatile the equity markets are, why do we even bother with that? Why don't you just invest in fixed income? Page 7 indicates why we have a tendency to think of fixed income as steady sailing and nothing to see here type of investment. Even within fixed income, we experience volatility that we have to manage and account for. Again, many years positive, as we would expect, but in between, a lot of volatility and negative numbers. And probably there's no one that would have said, sitting in my seat, that when they looked at 2021, they would see down 17% in fixed income at one point in time. So again, all this goes to say we live in a very volatile world. It's what we do for a living. And our job is to manage a portfolio that both takes advantage of that volatility and protects against that volatility. So as we switch to page 8, how you read the numbers is very important, and how they're presented is very important. The top half presents our annualized fiscal year numbers. Again, this tends to, because we're looking over a longer period of time, smooth out volatility. It's entirely accurate. It is entirely how we think about our performance, but it masks some of the volatility. So I would say to you, fiscal year to date, as of January, we're up almost 5%. As we look over 3, 5, 7, 10, and longer, this is an exceptional track record that has garnered for the state of Minnesota and its stakeholders significant returns. As we drop below to the charts, you can see that we're not immune to intra-year and inter-year volatility. We see some years, like fiscal year 2022, down almost 4%. The year before that, up 30, et cetera. This adds up to an exceptional track record, but again, we want to make the point it's not without volatility and variability. So again, you might say, why do this? Why bother with all this volatility? Page 9 is the why. Page 9 is the why. It's why we are willing to put the state's money and your money into these markets. It's also why we don't simply invest in only fixed income. Now, this is an oversimplified chart because it doesn't account for inflows and outflows that happen. It's very simple. It just tracks the return of a single dollar that could have been invested on January 1, 1979. In the red, it's what would have happened if you would have invested that single dollar in what's widely viewed as the proxy for fixed income. That's the Barclays Ag. And if you'd done that, you'd still do okay. But that $1 over that long period of time would only have turned into $17.49. Now again, we don't deal with single dollars, we deal with billions, so magnify it. However, if you recognize that you're a long-term investor willing to have a carefully crafted, diversified portfolio, and you'd been willing to invest in our portfolio, and when I say that, again, I want to acknowledge the people that have come before me, their portfolio, that single dollar would have turned into almost $60. That's how we think of the portfolio. If you are willing to invest a dollar for the long term carefully and you pay attention to your asset allocation, you will reap the rewards. So that's where we've come. That's how we think about investing. And the question is, how do we think about the future of investing? We think about the future and we plan and model out these portfolios and execute on them through an asset allocation. We tend to do that every 3 to 5 years. We intend to do an asset allocation, I believe, this fall. So when we come back to you after that's completed, there will be a deck of very complex slides. You're not going to see that today. We're just going to talk about principles. But I do want to talk a little bit about how we think about that and what you should expect to see. When we think about asset allocation, we're always balancing 3 things: risk, reward, and liquidity. And I don't want liquidity to get lost in this conversation because it is critically important. We said it the last time we were here. Liquidity for us means we always have to have the resources available to pay every member's retirement check every single month. If we fail to do that, we have lost our reason for existing. So when we think about our portfolio, we have to think about liquidity. And we ask ourselves at all times two key questions. Which of these asset classes are appropriate for this pool, and how should they be combined? Because how they work together is really important. So if we look at the far right, private equity, what this chart is showing you that each of these asset classes, these bubbles on this chart, they give us different mixes of return on the left-hand side and risk. Now, some would say private equity. Some would say high risk, but very high return. We have that in our portfolio. It has been one of the highest returning allocations across our history. We've been invested for 40 years. Some would say, why don't you just invest the portfolio in private markets then? That seems simple. Well, we wouldn't be balancing then liquidity because private markets are by definition illiquid. You cannot access your money on demand. And there is some risk. So that's one example of why do we look at combinations and how they work together so that over long periods of time, we can deliver an expected return. Again, when we come back in the fall, we'll go through all of these asset classes with you and how they behave together. So asset allocation. How do we think about that? It's in our investment beliefs. It is a core principle of institutional investing. The decisions we make in asset allocation are the primary determinant of our outcomes. It's the most important thing we can do as an organization. Some think picking a particular manager is the most important. It actually isn't. What matters is our decision of how much public equity risk we're going to take, how much fixed income we're going to take, et cetera. So we take this very seriously. It has significant impacts for the future of our members. As we look at the arrow below, again, we are, as we do these asset allocations, balancing all of these boxes. As we look at these bubbles and how they fit together, as I mentioned, risk, return, and liquidity, we're thinking about the roles that these asset classes play together. And then we're putting them into models with a lot of assumptions. Like all models, you can have the world's best model, but if your assumptions aren't right, the output's not going to be great. So these assumptions are critically important. We've listed a few of them here. And you've heard about them. I won't go into great detail. You heard about them from the actuaries, I think, last week. You might hear about them from some others today. But we're looking at long-term capital market assumptions to get some guidance on return expectations looking forward. Again, we're a very long-term investment pool, so we're looking over 10, 20, 30-year and beyond time periods. We're looking at volatility. We certainly don't want a collection of things that are going to be all up 30% or all down 30% at the same time. Correlations, how do they move vis-a-vis each other during periods of time? The time horizon I mentioned, it's very long. And then we're looking at concepts like alpha and premiums. Alpha meaning, as we think about our experience, our expertise, our managers, how much return can we generate over what the market might give to an index fund? The premiums, we have a belief that if you're a long-term investor investing in equity markets, both public and private, that you will garner more of a return, for example, versus fixed income markets. So it's an amalgam of all of these assumptions and a few others that go into the models to spit out a number of options about the asset classes, the return expectations, and the volatility. We take those and we run them through scenario testing. What would happen with that outcome if we had the 2008 Great Financial Crisis, the oil crisis, name 20 others. We never experienced the same crisis a second time, but sometimes they rhyme, and it's important to see how a modeled portfolio would behave. And I can't emphasize enough as we get to the far right-hand side, notwithstanding great models, great income, or great assumptions, we simply have to apply judgment to what the final outcome is. And I think sometimes that last box does get lost. So with all of that, we'll come back to you in the fall and show you what we expect the portfolio to look like for the next 3 to 5 years. We don't have that slide today, but we'll be back. And then finally, I believe the topic of interest for some is the investment return assumption. How do we think about that? What I would say, I mentioned in the last time we testified, how we think of the investment return assumption as investors is slightly different than how actuaries think about the investment return assumption. But I do want to be clear, they do rhyme. How are they different? Time horizon. We're looking over 20, 30-year time periods as we need to. Actuaries are now coming back and recalculating every single year, and they're looking at more like 10-ish year time periods. The actuaries don't have the data to calculate our, what I call the alpha. What does our portfolio experience look like? And there are a few other differences, including how these are used. Ours is for this asset allocation. It's both an input and output in some ways. For the plans, the actuaries, this rate is a discount rate largely. It's how do you calculate the current cost of your future liabilities. These are different, but again, they rhyme, because at the end of the day, our investment portfolio is generating annually about $5 billion that goes out to pay benefits. And so we're one leg of the stool that pays future benefits. The other legs obviously are employee contributions, employer contributions, and sometimes state contributions, state and local government, I guess. All of those work together, and if you don't have the right investment return assumption, you certainly don't know what those contributions should really be. So it's important to get it right. We're not here today to suggest that there's a correct number. However, as we said last week, being conservative is definitely a plus. And if we did the back of the envelope, and I want to stress back of the envelope, based on the capital markets assumptions that we see today in our experience, our expectation, that's an important word, is that when we do that asset liability study and come back to you, our expectation is that you'll see and hear us say 7% is a reasonable number. Again, understanding that there's a range of outcomes, there's judgment and reasonableness. So with that, I'll stop and take any questions.
Thank you, Ms. Schertz. We have about 10 minutes for questions, members. Please raise your hand if you have any questions. Representative Nadeau.
It was too quiet, Madam Chair. So I have two questions. I'm going to start at the end, and you said that, we're going to do this asset liability study, and you're going to come back and you're going to probably say that 7% is reasonable. Is 7.25% reasonable? Is 7.5% reasonable? So I want you to talk about that a little bit because you offered it. And then the other thing I want you to comment on a little bit about how the time horizon, have our markets become more volatile over time? I mean, I looked at the one of the slides, slide 6. It doesn't look like it's terrible, but there are phases in there where it's gotten more volatile. Can you talk about that, and have they become more frequent?
Director Schertz.
Thank you, Madam Chair, Representative Nadeau. And thank you for breaking the silence. I did think for a second that I was going to just get to walk away. There's a little bit of hopefulness there. Thank you. So the first question is, what is reasonable? By definition, what is reasonable is a wide open playing field, right? I think what we're all striving for in our world is take models, apply judgment, and come up with a range. I think the frustrating thing about what we have to do is that in a world with so much data, we're trying to identify a single data point and say that's the right answer. And I think it's important to recognize that. So, again, could 7.25 be reasonable? I think the models would suggest it's not impossible. Again, I want to point to 2022, down 34%, and we end up 20. Nobody would have said that was reasonable, right? No one, including me. So I think that there is a range of possibilities between reasonable, likely, possible. There is no way for me to say that 7.25 is wrong. I can tell you where I'm more comfortable when I look at and apply judgment. I believe 7 is reasonable. I believe that's where our asset liability will come out. I'm prepared to be surprised when we actually do it in the fall. You had a second question.
Representative Nadeau.
Madam Chair, yeah, the second question had to do with the trend in volatility in the markets.
Thank you. So when you look at the charts on showing the red dots in the equity markets and fixed income, they would certainly indicate the volatility has always been there. It absolutely has. It's core to what we do for a living. I think our lived experience in these seats and how it feels today is that it is definitely more volatile. In particular, right now, as investors in this market is more volatile, largely because we're coming out of a time period of intense, generous monetary supply, and now a period of very rapid tightening. So by definition, this period is gonna, I think we'll look back and see that it's one of the more volatile we've seen in a long time. So in our seats, it does feel more volatile.
Thank you, Director Schertz. Senator Nelson.
Oh, thank you, Madam Chair. Just a brief question on the assumed rate of return. Again, I know this is something that this commission will certainly be looking at diligently. And I appreciated your comment that without the correct assumption, we certainly don't know the correct contribution. And as you're weighing this 7.25, 7, whatever we believe, whatever that assumed rate is, can you just further detail? I think it's probably obvious, but I think it's good to hear exactly from the challenge. Is it more difficult if we overassume the assumption, therefore our contributions are insufficient, and what that looks like for Minnesota and retirees? And what does it look like if we under-assume the assumption, we perform better than assumed, and so our contributions were too great? And I'm just wondering if you can kind of lay that out a little bit about what it's like for the SBI, what it looks like for state government, what it looks like for the retirees.
Director Schertz.
Madam Chair, Senator Nelson, you know, I want to be very careful that I don't overstep sort of the bounds of what our role is versus the actuaries and the plans. But I would offer that big picture. Again, if we overstate the investment return assumption and we cannot actually achieve it over time, there will be a shortfall for all retirees, present and future. If we were to understate the investment return assumption and outperform, then there's a surplus. But there is a dark side to underestimating by too much. The dark side to underestimating by too much is, one, we're just not being honest about what our return potential is. Two, we will have asked employees, employers, the state, the taxpayers to simply put in too much into the funds and perhaps stress the ability of the funds to continue in some ways. So our job is to find that just right spot.
Thank you. Thank you.
Representative O'Driscoll.
Thank you, Madam Chair. Ms. Schertz, I want to go back in your presentation to slide 10, please. And it's the one that has the various different asset allocations with the little balloons or circles or bubbles. And I just was wondering, twofold, and maybe you and I can visit a little bit offline on this, but I was wondering if you could define for us private credit, what that looks like that you're investing in, private real estate, private equity, and venture capital. And the underlying question I have is, inside your various years of rates of return, how have these performed based on, paired with other asset classes that you might have invested in? Because those tend to have more volatility. Then the final question on here, and I'll be happy to backtrack on any of these, but with private real estate, I'd like to do a little bit of follow-up on that because of the changing work environment with more people working from home and some of the issues that may be associated with owning real estate as a result of that.
Director Schurz?
Madam Chair, Representative O'Driscoll. So as we look at, and I'd say big picture before I dive into the asset classes you've mentioned, when we think about public versus private, it really is simply public assets are those that can be bought and sold on the market, usually on a daily basis, usually. Or they're wrapped in a structure where the underlying assets can be bought and sold on a daily basis on a market. Private assets are those that are not available for sale on a daily basis. They are not publicly traded. And so as a simple example, private equity generally, when we think private assets, think about small businesses, a fund coming in to say there's a retiring owner, a private equity comes in and purchases the business, allowing the owner to retire. That is an example of a private market transaction. When we think about private credit is buying fixed income investments that tend to be slightly more illiquid and doing it in a format where you're trying to minimize the day-to-day volatility because you're not faced with the call of selling it on a given day. So a lot of times when we think about volatility is only dangerous if you have to sell that day. For the most part as investors, volatility is an opportunity. And if you can afford to hold it, you can reap the rewards. But if you are a forced buyer on the day of the volatility, you certainly will lose money and have no opportunity to recover it. So private credit, it's a simplistic explanation, but that's how I would think about it, is fixed income type investments where you're not worried about having to buy or sell it on a given day, generating typically a higher return than you would see in publicly traded fixed income. Private real estate, similarly. You could see a fund that's organized to buy multifamily rental units across the United States. That was a trend and still is, for example, in the Smile States, where they saw tremendous opportunity and demographic shifts to take advantage of. And again, if you have to buy a multifamily home and sell it on a given day, you don't know whether you're going to have a gain or a loss. But if you can hold it, sometimes improve it, and then sell it at the right time, you stand a much higher likelihood of having a gain. Your point about office space and malls is another concern, is well taken. I'd say it's the best funds have drifted away from that, and they're focused much more on other aspects of real estate, including industrial, storage, multifamily, et cetera. Venture capital, before I say anything else, I want to say venture capital, people have different perspectives on it. We have not, in the state of Minnesota, tended to invest in venture capital. We do not currently today. It's a topic of conversation. It should be always. When we think about asset allocation, we will discuss it. But given its more speculative nature, unicorns versus zeros, we have not historically invested there. Venture capital tends to be those great bets on the future technology or future companies that may not today have cash flow.
Just a quick follow-up, Representative O'Driscoll.
Thank you, Madam Chair. Just back on the real estate holdings, are you acting as a lender in those situations? Are you buying into funds that specialize in those? Maybe just a little bit more color on the background on that. And you talked about maybe buying multifamily and some of those kinds of things. Is the fund a direct owner, or how are you holding those positions?
Madam Chair, Representative Driscoll, thank you. We are not a direct buyer. In fact, by statute, we're required to have at least 4 other investors in any fund we invest in. And so we invest with other partners and many other what are called limited partners, which is how we come into an entity. So you would not find us owning a multifamily unit, for example, directly, but it could be within a fund. There are funds that will invest in, it's called the equity, the building itself, and there are funds that could invest in the debt. Real estate can be like any sort of, you could think about it like any security. There are many different ways to fund it. We participate, our general partners participate in multiple aspects of that industry.
Thank you, Director Schertz. And I do just have maybe one quick question for you. Not that I'm expecting you to predict the future, and I will not hold you to this, but I'd like to understand your opinion. I know that the Fed has been increasing interest rates, and they've been holding it there. But the rally in the year-to-date market, I think, signals something different, that they're seeing something different, or the market is seeing something different than what the Fed is. But I'm curious of your thoughts of like conversations around a looming recession and how that might impact and how you're all preparing for that, should that be the case. I mean, there's not agreement on whether we're going to be heading into one or not, and different people have very strong feelings whether or not. I'm curious, just your opinion and what you see.
Thank you, Chair Herr. I want to be very careful that a lot of what I'm about to say is my personal opinion, and of course, it flows through to our organization. And within our organization, at our investment committee level, we talk about this a lot. I would say first and foremost, it's a cliche, but I think it's one that's worn well over time. It's a very dangerous proposition to bet against the Fed, period, full stop. And so all of us obviously are listening closely to what the Fed has to say. And the markets are reacting every single day to what they perceive the Fed is saying. As I listened to the most recent interview, my takeaway from that was the Fed is trying to step back and say to the markets, we appreciate that you're listening and we'd like you to hear the following. We intend to get to 2%, period, full stop. They don't know how long it's going to take them to get there. They don't know for sure what the path is to get there. Today, though, they want us to believe that that's their intention. I don't know whether or not they can actually get to 2%. But what's important is that they want us to believe that. And so I think that we would be foolish to ignore that. I think that there is a lot of money waiting to invest. And when there's optimism, you see that money come into the market. Our view is, again, we have the benefit of this long-term perspective. We are constantly asking ourselves, do we like where we're invested? Do we believe in our managers? Do we believe in our asset allocation? And if we do, we need to stay invested. We're mindful that fixed income markets in particular right now react strongly to these signals. And so we're paying a lot of attention to our duration. On a positive note, while this is very volatile, when's the last time that you could actually say, gosh, I've got a pile of cash and I might be able to get 4% for that? It's a pretty good outcome. All in all, I'm from Peoria, Illinois. I am bullish on the domestic economy and its prospects. I'm not going to be surprised to see we have a recession, but I think that it'll be manageable. I think that there is strong momentum domestically to make sure that we have a stable economy for a long period of time.
Thank you, Director Schertz. And, okay, quickly, Senator Murphy.
Thank you, Madam Chair, and I know we need to move on the agenda. And I appreciate this presentation, and particularly this last part about the Fed. And you're from Peoria, and I'm from Janesville. And perhaps we have, some similar scrappy roots. When you talk about the Fed sending a signal, and wanting us to believe in attracting money into the market and the virtue of that. I wonder if there is a parallel when we think about the signal we send to retirees about the return. And if we are conservative about that, are we sending them a signal then to be conservative as well, not to anticipate what they hope or need in their pension, and therefore they change perhaps their buying, their participation in the economy And does that, because there are so many, have an impact as well? I know that this is going to be a subject matter for us through the course of this session, and it's an important one to me. And I always like to think about all of the participants and the ways in which they interact and the outcome of that.
Yeah.
So I liked what you had to say about the Fed and believing and attracting. And I also wonder if there's a parallel story there for retirees. Thank you, Madam Chair.
Director Schertz, I know this might be a little bit outside of your, like, what you might be able to share, but if you have any thoughts on that.
Thank you, Madam Chair. Senator Murphy, I think that the strongest signal that the State Board of Investments can send to retirees is that we will do whatever it takes to make sure that we never miss a payment to you. It's the most important thing that we do, that we will continue to review our portfolio, that we will be conservative, and that we will deliver on our mandate, no matter what. That is the most important thing. Your comment about retirees and the economy is spot on. They are a very important part of this economy. In some ways, it's a virtuous circle. They contribute, the state contributes. We make a promise, we have a covenant to pay them this money. In turn, they have the confidence to spend the money. This circle is incredibly important, and we intend to maintain it.
Thank you, Director Schertz, and thank you, everyone, for the conversation today. We are going to move on to our next agenda item, so you all feel free to leave the testifiers table. Our next item of business is to consider House File 1468 and Senate File 1377 from Representative Nelson and Senator Rasmusson. I think Representative Nelson is taking a call that he needs to right now, so it'll be Senator Rasmusson. And before we begin the presentation, I will say that my intention today is to lay this bill over for further consideration later this session. Under our designated legislative authority, the plans have asked us to reduce the investment rate of return assumption for their plans to 7%. However, numerous members of this plan are concerned and that this will endanger their benefits and impact the support received from us. So I am confident, though, based on our conversations today, based on the expertise that is on this pension commission, that we will be able to, come to a decision on how we will address this assumed rate of return. So today, we are going to be hearing from a number of individuals on their, testifying on this particular topic. And so I want to make sure that we respect everybody's time and those who made it here to be with us. And so with that, I'm going to ask Deputy Director Burkett to just explain the bill a little bit, and then we'll have Senator Rasmusson go over the bill with us.
Thank you, Madam Chair. House File 1468, Senate File 1377 is a fairly simple bill. It just changes the investment return assumption from 7.5% to 7% for 9 plans. That's 8 statewide plans and the St. Paul Teachers Retirement Plan. Since there's been a lot of discussion about this change already, I'll just keep my comments pretty brief here and just highlight a couple things that are in the staff summary. The first one is on page 5 of the staff summary. This is a summary of the information that the plans have provided on the cost to the plans for changing the investment return assumption. In the table there, you can see the change in the actuarial accrued liability, the change in the funded ratio, the change in the contribution sufficiency, or in some cases deficiency, and change in the projected full funded date. And I'll just draw your attention to the fact that we've got 5 plans that would not have a funding deficiency if this change was made, and 4 that would. And I would just point out the 4 are the MSRS correctional plan, the police and fire plan, the para-correctional plan, and TRA. The other thing I would just highlight is that I don't think there's been much discussion so far about the small changes that might affect some member benefits from making this change. And that really occurs in 3 areas. The first is in purchase of service credit. Members would spend a little bit less money if this change was made when purchasing service credit, which they do in a few different situations, including repaying a refund or in some of the leaves that are occasionally taken. The other, another area where they could be affected would be the actuarially equivalent early retirement factors, which 3 plans have. That'd be the MSRS general plan, the para-general plan, and the para-correctional plan. Participants in those 3 plans would see a minor improvement in their benefit if retiring early, if you change this rate of return assumption. And the final one is the unclassified plan annuity rates. Participants in the unclassified plan would see slightly worse annuity rates when they go to retire if you make this change. Madam Chair, that's all I would offer in comments.
Thank you, Deputy Director Burkett, and I will go ahead and turn this over to Senator Rasmusson.
Thank you, Madam Chair. And before I begin, I have an author's amendment noted as the 1A amendment.
And can you just talk a little bit about what the amendment is, Senator Rasmusson?
Yes, Madam Chair. Nonpartisan staff identified that in statute, there are a few places that have applicable interest rates that are connected or have historically been connected to the assumed rate of return. And so this would simply adjust those interest rates to match the 7% assumed rate of return in the bill.
Okay, any questions on the amendment? If not, all those in favor of adopting the amendment, say aye. Aye. Any opposed, nay? The amendment is adopted. Senator Rasmusson, on to the bill.
Thank you, Madam Chair, and I appreciate having the chance to talk about the assumed rate of return today and the bill in front of the commission. It's very important to understand that we want an accurate assumed rate of return for Minnesotans, because an accurate assumed rate of return means that we're treating people participating in our state pension systems fairly. It makes sure that we're balancing assets and liabilities. And in the past, when you see unfair outcomes in our pension system, it's often because liabilities and assets were not matched. And if we want to treat actives, retirees, future actives in an equitable way, we need to make sure that we're accurately matching our contributions to the benefits that we're promising Minnesota state workers. And I want to be clear that the goal isn't to have a higher assumed rate of return or a lower assumed rate of return, but simply a more accurate one. It's actually an issue if you have an assumed rate of return that is too high or too low. For example, if we have an assumed rate of return that is too high, we will be underfunding our state pension plans. We will not be putting in enough money to meet the benefits that we promised to hardworking Minnesotans. On the inverse side, if we have an assumed rate of return that is inaccurately low, we will be making pension benefits look more expensive than they really are. The reason we're here talking about moving our rate of return from 7.5% to 7% today is because the professionals who advise our state pension system are telling us very clearly that 7.5% is too high. If we look at the National Association of State Retirement Administrators, they keep track of the top 131 largest public retirement plans. Only 5 plans out of the 131 outside of Minnesota have a rate of return of 7.5% or higher. The median is 7% within that group. The commission's actuaries have looked into what should be the assumed rate of return, and the near-term recommendation has been to reduce the statutory return to 7%. Then for all of the state pension plans and their boards, they all use numbers internally that are lower than 7.5%. Para uses 6.5%, MSRS uses 6 3/4, and then TRA and St. Paul teachers both use 7%. And all 4 plans are recommending and asking that this commission move the assumed rate of return down to 7%. I also wanted to point out that GRS, which is the actuary for para and MSRS, actually recommended an investment return assumption range from about 5.6% to 6.55%, well below our current 7.5%. Changing to the rate of return to 7% represents a prudent decision. There's not a single professional that I've heard from who works for the commission or any of the plans that is advocating for anything higher than 7%. And there's actually, some advice out there that would suggest perhaps having a lower than 7%. Even though a 1/2 of 1% change might not seem important, it's important for the commission to understand that it represents a $5.9 billion unfunded liability. And it shows that, as the commission staff highlighted, that 4 plans that currently have a contribution sufficiency under the new assumption will show a contribution deficiency, including 1 plan that at 7% will never be funded. Without making this change, we will be underfunding and underinvesting in Minnesota's pension system because we'll be expecting investment returns that are unlikely to materialize, leaving these funds short. And I would also suggest, Madam Chair, to the commission that this change supports the hardworking men and women of Minnesota who carry out the important work of the state and local units of government. Without this change, it allows government to underfund their pensions, risking unequitable outcomes in the future. Madam Chair, would you like to move to testifiers or?
Thank you, Senator Rasmusson, and we will move to testifiers. And members, we did get a chance to ask questions on the system rate of return when there was a presentation. Due to the shortness of time today, I do ask that we're going to hold our questions and that we're going to give our public the opportunity to share their testimonies. And so with that, we do have 10 people signed up to testify, and we're giving each person 3 minutes. That means that's still 30 minutes, and we have one more presentation after this, so I want to be respectful of that. Testifiers, I would love to give you all the time, so you can always send in additional. We've been hearing a lot from all of you via email, so know that we're not trying to not hear people today, but we want to make sure everybody gets a chance to be heard. I will be timing just to keep us to 3 minutes, so when you hear the bell, if you could just prepare on wrapping up your comments, that would be greatly appreciated. I'm going to call up the first testifier, and then I'm going to identify who the second person, so just to be ready to be on deck. So the first person who will be testifying is Doug Anderson, Executive Director of our PARA plan. On deck is Aaron Leonard, the Executive Director of Minnesota State Retirement System. Please identify yourself for the record and begin your testimony.
Good morning, Madam Chair and Commission members. I'm Doug Anderson, Executive Director for PARA. Thank you for the opportunity to testify. Many of my comments are going to echo what you just heard from Senator Rasmusson. PARA does support lowering the investment return assumption to 7%. In late 2021, PARA's board took a position for our staff to advocate for an assumption change to our actuary's recommended range, which was about 5.6% to 6.5%. In 2022, the board added to its position to accept a change to 7% as progress towards that actuary's recommendation. The following 3 points are what I think you should know about PARA's position. One is our board fulfilled their fiduciary duty. Our board considered the prudent person standard that if they don't have the expertise, they need to hire, monitor, and follow the advice of the experts. With no contrary expert advice offered to counter our expert's opinion, the board's position is to support and advocate for our actuary's recommendation. Number 2, we have highly qualified experts. Our experts include very experienced individual actuaries who have a lot of experience in setting assumptions. They work for a national firm, highly respected actuarial firm that has a lot of resources. And since actuaries do not have expertise typically in setting long-term economic forecasts, they rely on investment consulting firms for advice. So the actuarial firm reached out to 12 investment consulting firms. Each of these firms has a multitude of professionals with specific expertise in forecasting future investment returns for various asset classes. And PARA's position reflects the confidence that we have in the high-level professional expertise of our advisors. Our board does share stakeholder concerns about issues such as inflation, high employee and employer contribution rates, intergenerational equity, long-term sustainability. However, stakeholder input on investment return assumptions should be limited only to what they can offer as expert advice on future expectations. Individual opinions and prior return averages are not necessarily substitutes for expert advice on future expectations. We understand some stakeholders may not like the expert opinion, but action should not be avoided or delayed because we don't like an answer. Our experts have raised concerns. None of the 12 investment consulting firms believe there was better than a 50% likelihood of achieving the 7.5% return. Only 2 of 12 thought there was a likelihood of beating 7 or 6.5. That was better than 50%. I could go on and on about the findings in the report, but it's very clear where the recommendation why the actuaries interpreted the information to say they're recommending 5.6 to 6.5 and 7.5 is no longer reasonable. This is important not to delay this decision. We do have early retirees that are being immediately impacted by this. They're being charged the current actuarial rate for their reduction for their benefit. That's over 2,500 members a year. So it's been 3 years now that our actuary said this is unreasonable. That's 2,500 members a year that are having a lower benefit as a result of this higher assumption.
Mr. Anderson, if you could wrap up your testimony.
I will, thank you. In summary, our board position reflects that we rely on our experts. They're highly qualified and they have a clear recommendation. That's why we support this bill. Thank you.
Thank you, Mr. Anderson. Up next is Ms. Erin Leonard, and on deck is Mr. Jay Stoffel. Please identify yourself for the record.
Good morning, members. My name is Erin Leonard. I'm the Executive Director of MSRS. In the interest of time, I will keep my comments very brief. The staff summary in the prior testimony has been very comprehensive, and a lot of what's been said by Senator Rasmusson and Mr. Anderson is exactly the position of the MSRS board. I'm here to express support for House File 1478, Senate File 1377 to reduce the assumed rate of return from 7.5% to 7%. Reducing the return assumption is the position of the MSRS board based on the advice of the MSRS actuary and discussions over the last 2 years. Both in 2021 and 2022, the MSRS actuary advised that the current assumption of 7.5% was outside of the range of reasonableness to value the liabilities of our pension plans. Reducing the assumption would bring MSRS plans in line with the national median of other public pension plans around the country. The National Association of State Retirement Administrators' most recent report regarding the investment return assumption from November of 2022 indicates that 123 of 131 plans around the country are using an assumption lower than 7.5%. Only 8 systems, including the Minnesota plans, are using 7.5% or more. The median among these plans is 7%. Thank you to the authors of the bill for bringing this legislation forward. We appreciate your attention to this matter and the opportunity to lower the investment return assumption and bring us in line with our peers around the country and within the advice of our actuaries.
Thank you, Ms. Leonard. Up next is Mr. Jay Stoffel, and on deck is Philip Tenchik. Please identify yourself for the record.
Good morning, Madam Chair and members. My name is Jay Stoffel, the Executive Director of the Teachers Retirement Association. And I will keep my comments brief. I also agree with my colleagues as they explained their approach. We have had for 2 years now a bill, some pension reform legislation last year and this year, which included a lowering of the return assumption from 7.5 to 7. The TRA board affirmed that decision again this year in January at their board meeting. Our actuary has recommended a return assumption of 7% for our accounting valuation, which we've been using for 2 years. And we're about to embark on an experience study that will evaluate all of the assumptions in the plan for the funding valuation. But I expect that to contain a recommendation when we receive it in June of an assumption something lower than 7.5 for the investment return assumption. So with that, Madam Chair, I'll stand for questions.
Thank you, Mr. Stoffel. We're going to move on to the next testifier, which is Executive Director of St. Paul Teachers Retirement, Philip Tenchik. And then up on deck is Brian Rice with the Minnesota Professional Firefighters and Minnesota Police Fraternal Association. Please identify yourself for the record.
Morning, Madam Chair, Commission. I'm Philip Tenchik, the Retirement Director for St. Paul Teachers. See if we can see that. Okay. I think, like the other plans, the St. Paul Teachers has set its valuation assumption for the liability at 7%. So we do concur that that is the correct rate to be using to discount our liabilities. However, I think Senator Rasmusson put it very succinctly when he said it's important to match the assets and the liabilities. The mechanism you use to do that is contributions. We've seen in the past when that doesn't happen, you get large red boxes on your funding report card. Moving forward, without funding this assumption change, we move from the green line, the upper green line, to the lower purple line, which is a new red box that needs to be funded. Rather than being a $330 million box, this would be a $600 million box over the life of our actuarial amortization period. And in order to counteract that red box, if we don't receive direct funding, the other mechanism we have is through investment. We would have to take additional risk. That puts more downside risk at play. So showing you here two options under the current contribution regime, not the funding regime. We'd have to maintain our allocation, which is roughly 80% risky assets. So the possibility of a bad market, we would have nearly a 24% loss. If we are funded at that 7% rate, we're able to reduce risk greatly, moving to only 55% risky assets and a downside risk of only 16% in bad markets. We'd be able to take out a third of the investment risk that our retirees are exposed to if we are able to fund this contribution or fund through contributions, this decreased rate of return. So in summary, I would note it's the assumption, it is not the assumption that drives actions, it's the contributions. Thank you.
Thank you, Mr. Tenchik. Up next is Brian Rice, and on deck is Caitlin Schneider with Education Minnesota. Please
Thank you,
identify
Madam Chair.
yourself to the record.
My name is Brian Rice. I'm here this morning representing the Minnesota Professional Firefighters, an organization of 2,000 firefighters in 46 locals throughout the state, and also the Minnesota Police Fraternal Association, which is a group of 940 retired police officers and surviving spouses who are para members. The Professional Firefighters and Police Fraternal Association requests that you do not change the assumed rate of return without also considering several other important factors which influence pension plans in Minnesota. In 2014 and 2018, the legislature did reduce the assumed rate of return from 8.5% to 7.5%. But in doing so, they provided funds for the effect of lowering that assumed rate of return a full percent. And more importantly, in those bills, the members that I represent were squeezed quite significantly. They faced higher contributions and they faced lower COLAs because the experts said that the assumed rate wasn't sustainable and it needed to be paid for. And in those two bills, the retirees and the members paid for it, and pretty severely. Just last year, when this pension commission considered lowering the assumed rate of return from 7.5 to 7%, you did what I would say is the right thing. You put $150 million annually to make up for the effect of the cost of lowering that assumed rate of return. But you also extended a lifeline to these retirees with a COLA increase and also contribution increases. We've heard a lot about NASRA. Let me tell you about NASRA. Minnesota has been doing pensions on the cheap for a long time. My handout has the NASRA report. On average, states throughout the country contribute 5.2% of their total revenue to pensions. Minnesota, 2.4%. We rank 46 in the nation on spending per capita for pensions. So I'm great with you taking the NASRA assumed rate of return. Give us the money. Give us that extra probably $1 billion a year to fund these pensions at the same rate. Also, one of my other handouts is from NASRA, the same one the experts are relying on to lower the assumed rate of return. Minnesota, for the last 20 years, has made only about 82% of the actuarially determined required contribution to these pension funds. Surprise, surprise, after 20 years, the pension fund's only 80-some% funded. I mean, is that a surprise? No, it isn't. What's the cause? The other fact is this. NASRA also has got a report. Normally, employers contribute 70% of the money going into a pension plan. The employees put in 30%. In Minnesota, last fiscal year, employers put in $1.3 billion, employees put in $1.1 billion. That's a 54-46% split. Who's doing it on the cheap? The employers are doing it on the cheap, not the employees. And so if you want to look at this assumed rate of return, great. You've heard the experts on the thing, and you're hearing from the experts that we can't weigh in on it. It's time that we weigh in on this, and it's time that this legislature, if you're going to make another move to lower the assumed rate of return, please, please, please put the dollars in to make it for that effect. As Senator Rasmusson pointed out, it's a $5.9 billion
Mr. Rice,
hit
if you
to the
could
plan.
wrap up your testimony, please.
I will quickly. With inflation, I'll make it quick. It's $5.9 billion unfunded liabilities. It's $400 million. We have $83 billion in assets. Lowering the assumed rate of return takes $400 million a year out of the projected cash flow to this system. Thank you very much for the opportunity to testify.
Thank you, Mr. Rice. Up next is Caitlin, and on deck is Ethan Vogel with AFSCME. Please identify yourself for the record.
Good morning, Madam Chair. My name is Caitlin Snyder with Education Minnesota. We represent 86,000 active and retired educators across the state. We are being told to trust the experts, but the experts don't agree, and the boards do not agree. The actuary who supports the work of TRA has said that 7.5% is within range. And the boards of TRA and St. Paul TRA have taken votes that say any change in the assumed rate of return should be paid for by the state and coupled with benefit changes. So to move part of their recommendations without the full recommendations at this point is premature. A 0.5% change in the assumed rate of return is a dramatic change. And we would be making this change without a full scope of what this would mean for our pensions funds. Later this year, we will have an experience study from TRA. We will have an asset liability study from SBI, and it makes sense to wait for those pieces of information before making changes. When LCPR has the information available to make these changes, it must be paid for by the state, and we must follow the regular deliberative process of pensions. Thank you.
Thank you, Ms. Schneider. Up next is Ethan Vogel, and on deck is Edward Reynoso, Director of Political and Legislative Affairs with Teamsters Local 320. Please identify yourself for the record.
Thank you, Madam Chair. Good morning, Commission members. My name is Ethan Vogel, Legislative Director for AFSCME Council 5, and I'm going to provide comments on behalf of the Public Employee Pension Coalition, referred to as PEPSI, as well as AFSCME Council 5. PEPSI Coalition members represent several active and retiree organizations whose members contribute to and draw benefits from our state pension plans. We are in every corner of the state. We are in every one of your legislative districts. Our members are Republicans, our members are Democrats, our members are independents, and some of our members are entirely apolitical. But across the political spectrum represented within our ranks is a shared and widely held belief that our pensions are sacred and the prudent stewardship of our money, which has accumulated by means of several generations of public sector employees deferring their wages, is of utmost importance. We come here to engage with the management decisions of our pensions because the impact on all of our members is so significant. And we hope that you will see us as partners in this work. We absolutely need a seat at the table. As a coalition, PEPSI agrees that the investment return assumption should be the same across all plans where investment allocation is the same. That only makes sense. As a coalition, we are opposed to the investment return assumption being removed from the legislature's control. If you relegate control over the investment return assumption to the pension boards, you will see different return assumptions being applied even where the asset allocation is no different. And finally, as a coalition, we agree that if the legislature chooses to lower the assumed rate of return, the assumption, that reduction should be funded by the legislature to maintain the current funding trajectories of our pension funds, and that whatever additional resources are made available for pensions this session should be distributed equitably. And on behalf of AFSCME, I just want to push back on the notion that we are at risk somehow of overinvesting in our pension funds. It could not be further from the truth. We're nowhere near that, and even in the most recent years where we have come close to the actuarially determined contribution, it's not because the state has been over benevolent with their contributions. It has entirely been borne by actives and retirees. The COLAs are far too small, the retirement ages are too great, and we need to get to a point where we can change those things. Thank you, Madam Chair and Commission members.
Thank you, Mr. Vogel. Up next is Edward Reynoso, and on deck is Dr. Michael Landers with Minnesota Retired State Employee Association. Please identify yourself for the record.
Thank you, Madam Chair. My name is Edward Reynoso. I am the Legislative and Political Director for Teamsters Local 320. I appreciate the opportunity to be here today and convey some of the concerns. I'm not going to repeat what Mr. Vogel said. We support that position 100% with regards to legislative control and changes to the assumed rate being paid for and the same rate of return applying to all of the the all of the plans. I want to touch on a point of inflation and the impact that this has had to our members. Just briefly, it's not even been a slow impact to our members. It's been a significant impact to the value of the pensions. If you look at the inflation rate for 2021 was 7%. For 2022 is 7.1%, yet the COLA is at 1%. That's something that's just out of line. We certainly hope that at the end of the day, this is going to grow into a much broader bill to address many of the concerns that we have within the pension system itself, and that it's going to be something that we can get behind with our members. So that's the end of my conversation, today. But we hope that we could continue to have these conversations before something else has moved forward. Thank you.
Thank you, Mr. Reynoso. Next is Dr. Michael Landers, and last will be Mark Halverson, Executive Director of the Minnesota Center for Fiscal Excellence. Haverman, my apologies. Please identify yourself for the record.
Madam Chair, member of the commission staff, thank you for the opportunity to speak with you here today. My name is Mike Landers. I live in Woodbury, and I spent 27 years as a finance specialist with the Minnesota Department of Education. I'm here today on behalf of the Minnesota Retired State Employees Association, MRSEA. MRSEA was established in the 1940s, initially as a social organization. However, we expanded our focus in the early 70s to include advocacy on behalf of our members, particularly in the area of pensions and group health insurance. We represent thousands of retired state employees from all levels of state government and from all areas across the state of Minnesota and beyond. I'm here today because our members are contacting our board and our officers, expressing their deep concern about the fact that inflation is eroding the value of their pensions. The COLA study required by the 2018 pension bill showed that inflation caused a significant loss in purchasing power over retirees' lifetime, thereby eroding the value of their pensions. And that was before the current surge in inflation, which doesn't show any end in sight. That's of immediate concern, offering some relief to our members whose purchasing power is declining at an accelerating rate. Of longer-term concern is protecting the health and sustainability of our pension plans. This bill proposes to lower the assumed rate of return. However, the assumed rate of return is only one variable affecting the health and effectiveness of our pension plans. Others include employer and employee contribution rates, benefit structures, assumptions regarding inflation, salary growth, mortality, early retirement, recruitment and retention, and others. We think a comprehensive approach to examining all the variables that affect our pension plans to ensure their health and sustainability into the future should be undertaken before making changes to some variables without consideration of their effect on all the others. However, as I stated earlier, our immediate need is to offer some relief to our retirees who are seeing the value of their pensions eroding due to the ravages of inflation. And we propose that the relief should be in the form of additional state aid to help keep our promise of a dignified, fulfilling retirement. And we ask for your support in this effort. Thank you for your time and attention, and I'll be happy to answer any questions anyone might have.
Thank
And
you.
I'm under 3 minutes.
Right there, just went off. Thank you, very, very on time. Thank you, Dr. Landers. And our final testifier is Mark Haverman, and if you could come up and identify yourself for the record.
Thank you, Madam Chair, members. My name is Mark Haveman. I'm Executive Director of the Minnesota Center for Fiscal Excellence. Appreciate the opportunity to testify today. MCFE strongly supports this bill, however, for reasons having nothing to do with being more realistic about what can be achieved with respect to investment markets or improving the odds of the State Board of Investment as being able to meet the assumed return. Our support is based on making some progress towards correcting the core problem plaguing our defined benefit system and properly valuing our pension obligations by discounting liabilities using the investment return assumption. Back in 2016, Governor Dayton's Blue Ribbon Panel on Pension Reform recommended immediate reduction in the assumed rate of return, but another of the panel's recommendations was overlooked and ignored. That was to examine the investment return and discount rate assumptions independently of each other. Why would the panel conclude that? State economist Laura Columba-Kiedis provided the answer before this commission in 2017, testifying on the approach to valuing future pension liabilities. In her concluding slide, she noted, quote, common view in economics and finance suggests discounting pension obligations with a rate that reflects the risk characteristics of those obligations. Pension obligations are low risk, they must be paid. Defined benefit plan experts also agree. Barton Waring is a staunch defined benefit plan supporter. He's a retired chief investment officer of Barclays and author of Pension Finance, putting the risks and costs of defined benefit plans back under your control. A quote, the use of an inaccurate discount rate creates real and consequential differences in the health of the pension plan, as the use of the expected return assumption as the discount rate virtually guarantees the eventual failure of any plan that uses it. Now, the risk of failure, of course, is very different for government because we have the power of taxation. So what do pension actuaries think about this issue? Well, that depends on who you ask. While states have grappled with this issue of funding their defined benefit plans, a debate has been taking place inside the actuarial community. The late Jeremy Gold was the vice chair of the Pension Practice Council of the American Academy of Actuaries and chair of the Pension Risk Management Task Force for the Society of Actuaries. In the fall of 2015, he offered a rather scathing critique of his own professional body and the standards of practice. Quote, what we have is a knowledge problem and a governance problem. The knowledge problem, actuaries in good faith understate the value of future pension payments by as much as 50%. Their clients want them to. The governance problem, actuarial standards of practice allow pension actuaries to cater to their clients while ignoring potential harm to third parties. Actuarial methods and assumptions continue to kick the can down the road and suppress true pension costs. Low current contributions cater to current taxpayers, but burden future generations with great risks and unacknowledged costs, unquote. When asked what should be done about all this, his reply was, get angry. In summary, the discount rate should be established independently of the assumed rate of return. That is not going to happen. This bill is a good start towards responsible pension obligation valuation, ensuring sufficient contributions, as you've heard, are needed for the pension plans in the years ahead. Thank you very much.
Thank you, Mr. Haberman. And I will have Senator Rasmusson and Representative Nelson. Do you have any closing comments for?
Thank you, Madam Chair. No, I'll let Senator Rasmusson. I had to step out earlier, so.
Senator Rasmusson.
Thank you, Madam Chair, and I appreciate all the testifiers and the engagement on this really important topic for Minnesotans. And I just want to make sure that the commission and folks understand that this bill doesn't change any of the actual returns. It also doesn't change any of the actual liabilities or the actual cost of benefits. It just makes sure that this entire pension system, that's really important to hardworking Minnesotans and Minnesota taxpayers, that we are looking at accurate information. And it's really about stewardship. It's about understanding what the cost is of these pension benefits. And I would argue, Madam Chair, that this bill helps make the case to those advocates who have said that Minnesota is underfunding our state pensions. They're right. If we adopt this bill, if it gets passed, it shows that we have an unfunded liability of $5.9 billion more than what the current math shows. And so I think this bill helps make that case and does not detract from any potential benefits in the future. It just makes sure that we figure out how to pay for them. And I think that this is one of these issues where if we do nothing over the next few years, we'll be fine. Nothing will really impact us. But this bill is about stewardship for the future. Because if we're wrong, if we're not looking at what the experts are telling us and adjusting our assumed rate of return and planning to that accordingly, we are creating future liabilities that will be borne by people not in this room. And I think it's an important part of our job is to take that into account. And for me, this is not just a numbers exercise, but it's actually personal. When farming got tough up in Ottertail County for my family, my grandmother took a job in dietary at the state hospital, putting in a career there and getting a pension benefit. And while the economics of the family farm were collapsing, that pension benefit provided for both my grandmother and my grandfather. And I think it's important for us to understand the obligations that we're making and the promises that we're making as a legislature. They're long dated. And in order for us to meet those obligations to the hardworking Minnesotans that have served the state well, we need to make sure that we're making prudent decisions today for their benefit. And so I appreciate the bipartisan, bicameral support on this bill, and I look forward to getting it done this year. Thank you, Madam Chair.
Thank you, Senator Rasmussen. And as I stated earlier, we will be laying this bill over. And I want to thank everyone who came in today to testify. Each of your voices are extremely important in this conversation, and that decisions have not specifically been made around what to actually do around funding. And so we appreciate that you continue to contribute to that conversation. Thank you, Senator Rasmussen. And we will be laying this bill over for inclusion later on in session. Next, we will have a presentation on the Department of Labor and Industry report called The Adequacy of Disability Benefits for Minnesota Police Officers. Presenters, if you are ready, if you could come up to the table and identify yourself. And members, I just want to put out there that we will be a couple minutes after 10 o'clock, depending how many questions we all have. And so if you could all just bear with us and let us finish the presentation, because this will be important information for future bills we will be hearing. Thank you.
Thank you. Good morning, Madam Chair, members of the Commission. My name is Kate Daly, and I'm the Assistant Commissioner at the Department of Labor and Industry. With me here today is my Deputy General Counsel, Laura Zajac, and Associate General Counsel, Ethan Landy. We are here on behalf of the Department of Labor and Industry to present a study that this commission asked the department to conduct last session. During the 2022 legislative session, the commission discussed a bill requiring the Department of Labor and Industry to conduct a study of the current benefits available to disabled or injured police officers. The bill was ultimately included in the final pension omnibus bill. The language required the department to issue a report in cooperation with the Public Employees Retirement Association on the findings of the study no later than January 15th of this year. The bill also required the department to hold a public hearing regarding the study and adequacy of current benefits to disabled or injured police officers, which the department held virtually on December 1st of last year. In testimony to this commission regarding the proposal, the department explained that the research and evaluation expected from the study was beyond the department's area of workers' compensation expertise. Therefore, the bill appropriated funding for the department, which was used to contract with researchers at the Institute for Urban and Regional Infrastructure Finance from the Humphrey School of Public Affairs at the University of Minnesota to complete the study. The lead researcher, Camilla Francesca, is attending this meeting today virtually and will be providing a short overview of the study. The report presents the findings from the university's research team. The study primarily considered workers' compensation benefits and disability and retirement benefits from the para, police, and fire plan, particularly duty and total and permanent duty disability benefits. The study evaluated the adequacy of these benefits for Minnesota police officers. It represents many months of research, data review, and stakeholder outreach by the research team and staff at the department and para. The Department of Labor and Industry believes that the final product from the research team meets the requirements outlined by the legislature and represents a thorough analysis of the issue that considers the views of all interested parties. The department would like to thank the research team for its hard work and efforts, staff at para for their assistance in conducting the study, and all the stakeholders who provided feedback. The department's role in this project was to administer the study as required by the legislature. To do so, department staff worked closely with the research team and para to ensure that the research team understood workers' compensation law had the data necessary to offer a statistical analysis as part of the final report, and was connected to the stakeholders who could share their expertise and experience. DLI's role was not to change, modify, or alter the results or findings from the research team. While it was necessary for the study to offer scenarios and examples regarding the adequacy of benefits for police officers, DLI does not take a position on whether workers' compensation benefits for injured police officers are adequate. This study is one step in continued dialogue regarding benefits for police officers. The department thanks the committee for the opportunity to present the study and looks forward to offering any assistance as needed for the commission continues to work on this issue. At this time, I would like to ask the commission to recognize Camilla Francesca Saramento and allow her to offer more details on the final report.
Ms. Francesca, please identify yourself for the record and continue.
Thank you so much, Assistant Commissioner. My name is Camila Fonseca, and I'm here as part of the research team that did the study on the adequacy of disability benefits.
Could you maybe speak closer to the microphone that you are using? We're having a hard time hearing you in this room.
Okay, can you hear me better?
A little bit better. We may need you to try to shout at us.
Okay, let's see. Will this work?
We'll go with that and just try to maintain that level of loudness. Thank you. Sorry about that.
No, it's okay. Thank you so much. Well, my name is Camila Fonseca, and I'm here as part of the research team that put together this study. So I will just talk briefly. This study just focused on police officers, and we're going to be looking into like the workers' compensation benefits and the para, police, and fire plan. So specifically on the duty and total and permanent duty disabilities. There are the benefits for injuries for police officers on the line of duty. So we review kind of the existing benefits available to the police officers here in Minnesota and in other states like Iowa, Wisconsin, Michigan, and Ohio.
Ms. Francesca, we are not able to hear you well in this space. Is there maybe someone who is at the testifier table that could go through the slides?
Turn up her volume.
It's max. It's up as high as we can do
Her
it.
volume is too.
Yeah.
Can you hear me better? Hello? Can you hear me better?
Not much better. Can someone at the testifier table maybe go through the slides quickly for us? Because it will be really difficult for us, and I don't want to waste the time of going through a presentation that people can't hear, so.
I understand. Thank you, Madam Chair. I will ask Laura Zajac, Deputy General Counsel at the department, to try to go through the slides.
That would be great. Thank you. My apologies, and we have our volume up to the max, and we're still having difficulties, so our apologies.
Madam Chair, Commission members, thank you. Laura Zajac, Deputy General Counsel at the department. I don't have the technical expertise in some of the scenarios that Ms. Fonseca has, but I'll review the slides and then hopefully we can cover that with questions. This slide, as Ms. Fonseca noted, the study included review of like states, similar states, as well as Minnesota's current benefits, similar levels, and then at the end we'll discuss scenarios of current benefit levels. The next slide, let's see if I can control it here. Oh, yeah, okay. Besides the data, both from PARA and Minnesota Workers' Compensation Database that the researchers looked, they also did qualitative interviews with 31 different individuals in 22 cross sections of organizations and stakeholders that are relevant to this issue. From the interviews with stakeholders, some of the key findings were the factors that enhance the adequacy of workers' compensation benefits. This includes presumptions in the law. For example, police officers and similar first responders have a presumption for that if they suffer a heart attack, pneumonia, post-traumatic stress disorder, that this is related to their work. Also, workers' compensation benefits are not taxable, which is a factor that enhances the adequacy. Factors that hinder the adequacy of workers' compensation benefits are the weekly maximum compensation cap. The report goes into some detail about the stage of a career that a police officer goes through and when they might hit that maximum cap that is applicable to all workers under the workers' compensation system, but comes into play specifically with police officers who generally have on the higher end of rate of pay, especially later in their career. Let's see here. Okay, great. Thank you. Please, thank you for bearing with me. Factors that hinder the adequacy for workers' compensation benefits include cost of living adjustments. They have not kept pace with inflation. Additionally, fixed payment for permanent partial disabilities. Permanent partial disability benefits are not calculated the same as wage loss. They're determined by statute for a percentage of a disability that is matched to the body part that is injured or the condition that the injury occurs. They were last updated in 2018, and the researchers noted that for police officers who received permanent partial disability benefits after 2018, that has not kept pace with inflation and has lost purchasing power. Other key findings for workers' compensation benefits hindering the adequacy of those benefits from interviews is accommodations for returning to work. Stakeholders noted that employers often deny accommodations. They may have trouble accommodating the return to work restrictions of the employees, and that hinders the capacity of police officers to come back to work and access temporary partial disability benefits, which are available when they're working but not at their full capacity. And that may be something specific to the line of work that they're in to accommodate those restrictions by employers. The last factor hindering the adequacy of workers' compensation benefits are settlements. There was concern from stakeholders that these are not adequate as compared to if they were receiving the benefits over the stream of their work life up to the age of retirement, and that the settlements might not be adequate if the police officers' health conditions are deteriorating over time. Those settlements can include a compromise of future medical benefits, and they also can be settled without that future medical component. Factors that enhance the adequacy of para, police, and fire benefits, as concluded by the researchers. The first is overtime is incorporated in the base salary. So if police officers are working overtime, that is included in the calculation that their benefits are derived from. A second factor would be the lifetime benefits. Workers' compensation benefits, there are certain benefits like medical care that go for lifetime, but the wage loss benefits do not. The para, police, and fire benefits are lifetime benefits that are long-term compensation, but as noted in the second bullet under lifetime benefits, the salary is frozen for injured younger officers because the calculation is earlier in their career when they might not be earning as much. And then the tax advantages, we covered that with workers' compensation. Thank you, Camilla. Factors that hinder the adequacy of para, police, and fire benefits. The salary base, again, this is as compared to over their lifetime. When are younger, the aspect of their salary being frozen in time at a younger wage loss, when they might not be earning as much. Cost of living adjustments, again, not keeping pace with inflation. And two more that were noted by stakeholders. One is the legal cost of consultation to put in your application for para disability benefits, and the lack of income while waiting for that determination, which may be several months. Again, this is the piece that I won't be able to cover as adequately as Ms. Fonseca, but our report does go into detail with 3 scenarios for a young and early career police officer, a mid-career officer, and a senior police officer. To do these scenarios, the researchers looked at the interplay and the actual data from para benefits and from workers' compensation benefits and mapped them out with assumptions about earning potential, return to work, and covered the disability conversion to retirement benefits that is at part of para. Key takeaways. Officers that are not able to return to work rely on the disability benefits, and those may not be adequate without that reemployment piece. The flip side of that is that reemployment earnings put the officer in a much better position than those who are not able to return to work. And senior police officers with more than 20 years may actually get disability benefits that are higher than the pre-injury net salary. All right. Thank you for bearing with me, and hopefully your detailed questions, we'll be able to hear Ms. Fonseca. I appreciate your time.
Thank you for filling in very last minute. We appreciate it. And we do just note that there is a final report that has been included in our packet. And so for any members to please if you have a chance to read over that. We do have a couple of testifiers here, and we have the room for just a little bit longer. I want to make sure that those who are here to testify get a chance to do so. We are going to limit your testimony as well to just a few minutes. So the first person is Doug Anderson with the Public Employee Retirement Association. And after that, we have two testifiers from the League of Minnesota Cities and Minnesota Counties, Dan Greenswick, and I'm not quite sure how to say that, the name, is it Jared Clawberg or Clawbog? So just be ready for the testimony. Introduce yourself for the record, and please move forward with your testimony.
Good morning again, Madam Chair and Commission members. I'm Doug Anderson, Executive Director for PARA. Appreciate the opportunity to testify. I'll be very brief. I appreciate the work that the U of M did to put this report together. It's a very complex issue, and they were very thoughtful in their findings. I would like to just clarify an update on one section of the report related to PARA. Appendix C talks about concerns related to the adequacy of the PARA Police and Fire Fund. And in the report, it notes some comments that I made to this commission back on February 23rd, 2021. So 2 years ago. At that time, the funds were riding high off some high returns. I did comment at that time that the rising number of disability claims was not affecting the sustainability of the fund. I did note that it would delay the date in which the funds would be fully funded, which means contributions would have to remain higher for a longer period of time, and there'd be probably a delay in doing any kind of benefit increase. 2 years have changed quite a bit. The returns haven't been meeting the assumption. You heard the comments about today about lowering the future assumption for returns. And then we have studied the impact of the higher disability rates and discovered from our actuary that's an estimated cost of 4% of payroll. So I can no longer say that disability trends are not going to affect long-term sustainability. They will. The plans now are on an unsustainable course. We need some corrective action soon, otherwise there'll need to be some increased contributions. So I just wanted to update and clarify on that. PARA staff has been working on looking at how benefits work. I think a very important distinction is that it is very possible from this report to draw two different conclusions. There are permanent and total and permanent disability members in our plan. That's a relatively small amount. It's possible that you may conclude that the benefits aren't high enough for that group. And then there's a different group, the duty disability members, which is the vast majority, and there's a big distinction there about what the impact of reemployment earnings mean for them. If they can have reemployment earnings, you may conclude that benefits are adequate. If they can't have reemployment earnings, you may conclude otherwise. So these are issues we are studying, and we're engaged with stakeholders now, and we expect to be able to share more with the commission later this session. So thank you for hearing my testimony.
Thank you, Mr. Anderson. And up next is two representatives of the League of Minnesota Cities and Minnesota Counties. If you could come up and identify yourself for the record and begin your testimony.
Thank you, Madam Chair. We will keep our remarks very brief. My name is Dan Greenswag. I'm the administrator of the League of Minnesota Cities Insurance Trust. LMCIT is a public entity owned by our member cities. In addition to providing property and liability coverage, we provide workers' compensation to most of the cities in the state other than 9 large self-insured ones. With me is my colleague Garrett from the Minnesota County's Intergovernmental Trust. He has a few remarks of his own, and he'll introduce himself at that time. We won't repeat our comments from the letter we provided to the Commission last Friday, but there are a couple of points we do want to emphasize. First, I want to start by thanking the university researchers and the Department of Labor for reaching out to us. We'll note that while the university study addressed some important questions, it raised at least as many as it answered. And they're really questions that are fundamental to making a fully informed decision on this topic. That's something we'll be happy to work with the other stakeholders in fleshing out. Second, law enforcement officers, like all employees, deserve to be financially protected if they're injured on the job. And reasonable people can disagree about whether our current system of workers' compensation and disability benefits is adequate. Ultimately, though, the appropriate benefit level can't be determined simply by calculating how much a hypothetical employee receives in a hypothetical situation. We really need to consider all of the policy implications, and that includes things like the role played by other benefit programs, such as 299A health insurance benefits, the Federal Public Safety Officers Benefit Program, tax treatment of benefits employees receive, the financial impact on taxpayers and our state pension funds, and the importance of encouraging people to return to work when they can. Our organizations and our members are public entities, so any increase in benefits has to be paid either with a cut in other public programs or a tax increase. Third, the questions posed by the report apply to all employees, both public and private. While law enforcement plays a critical role in Minnesota, and our public safety officers face risks most of us don't, their financial circumstances are not unique. If there's a concern about the adequacy of the benefits available to injured employees, that's a discussion that should include and apply to everyone. Nurses, loggers, office workers, and all other occupations, many of them lacking access to benefits as wide-ranging as the ones already available to law enforcement. Last, we can't keep loading public safety benefit costs onto the existing systems and assume that cities and counties will figure out a way to make it work. Our own insurance pools are facing challenges like double-digit premium increases and more complex case management, while our members are struggling with uninsured costs like lifetime health benefits, not to mention recruitment and retention. We're not arguing that the entire public safety infrastructure will come crashing down if these specific benefits are increased. That's not how these things usually work. But public safety is fraying around the edges in this state. We've seen small departments dissolve or consider it. Sheriffs are wondering how to cover shifts and fill vacant positions. We've been treating benefit enhancements as minor tweaks that don't amount to much. And if we continue to do so, we're never going to confront the significant policy effects they have. We need to be honest about our goals. If we're trying to provide a comprehensive, taxpayer-funded, no-fault health and disability safety net for a subset of public employees, we can do that. It might cost a lot. We'd need state help to get there, and our taxpayers and constituents might have something to say about it, but it's theoretically possible. If that's the direction we want to go, however, we need to know that so we can fund it, staff it, and manage it like the Health and Human Services program it would be. With that, I'd like to allow Gary to add a few comments of his own, if we could, Madam Chair.
Thanks, Dan. Madam Chair, members of the Commission, my name is Garrett Claybaugh. I'm the Executive Director of the Minnesota Counties Intergovernmental Trust. MCIT is a joint powers organization, and we provide risk management services to 81 of Minnesota's 87 counties and affiliated local government organizations. First, let me say I applaud the legislature's engagement on what is a very difficult topic of duty disability. And the rise of claims we're seeing for the benefit for our law enforcement officers. It's clear we've seen a period of unprecedented change and demands on law enforcement. These public servants play a critical role in our communities and deserve our best efforts in supporting that function as they support our residents. As the data from the university's report indicates, increased filings for duty disability benefits at para among law enforcement officers certainly is reflective of the physical and mental stress among these public servants in the law enforcement profession. As public employers responsible for providing critical community safety services, we grapple with the tasks of supporting our workforce, responding to new needs in our communities, and being effective stewards of increasingly limited taxpayer resources. While the university's report highlights tensions in the duty disability system, I want to spend just a minute talking about highlights, focusing on portions of that report. The first is vocational rehabilitation. We know that the workers' comp system is established as a three-legged stool made up of medical care, wage loss replacement, and rehabilitation, including vocational rehabilitation. As with many employers today, counties struggle to engage more workers for these critical jobs like those in law enforcement. Our local governments are challenged to find enough workers today to fill all the public jobs available. And while every step is being taken to ensure that our injured workers receive what they deserve, vocational rehab can play an important role in helping our injured find reemployment opportunities and taking fullest advantage of their workforce capabilities. Each of the three legs of the stool need to be emphasized for the system to be working effectively. Second, the full complement of benefits. The university's report recaps the array of benefits available to our injured law enforcement officers, but focuses the bulk of its analysis on the adequacy of workers' comp and para. But it's critical to note that there are additional benefits that injured law enforcement officers are eligible to receive, which other public employees do not have access to, including the continued health insurance benefit to injured officers and their families. And while these benefits are well-deserved, state promises of funding this benefit and local government mandate have never fully paid for the costs paid for our local government employers. The legislature should consider again its practice to support replacement of these supplemental expenditures from state public safety funds. Third, as it relates to PTSD-related departures specifically, as members of the Commission are acutely aware, an increasingly frequent component of duty disability touches on officers experiencing PTSD. While this report does not touch on the historic number of departures, AMC, MCIT, and our other organizational affiliates for local government urge the Commission to think about innovative approaches to supporting officers suffering PTSD, to provide the medical attention to assist in their medical health challenges, and find ways for workers to return to their profession with the completion of successful medical care. We encourage the legislature to take up the proposal that currently has been filed on that topic and provide those tools to employers and employees to address that critical challenge. We remain committed to working and supporting our local government partners in this work and supporting our public employees as well. We're proud of our 44 years of support for that work and be happy to take questions.
Members, do you have any questions? Seeing that there are no questions, thank you testifiers and thank you for the presentation today. We will have a bill before us in the coming weeks to look at this particular topic, so thank you so much for the presentation. That concludes our business for today, members.